Good morning and welcome to community members to this webinar on the allocation of professional firm profits. Look, it's really great to see such a good turnout for this because we're well aware that you're all very, very busy at the moment. For those that don't know me, and hopefully that's not many, my name's Tony Dickens and I'm the Executive Professional Partnerships at HLB with particular responsibility for looking after the HLB community. Today, our tax partner, Peter Bembrick, is outlining how the ATO's new rules differ from its previous guidelines. He's also highlighting some common situations, excuse me, where risk level may increase under the ATO's new approach. And he's covering some recommendations offered up for ATO consideration since the Practical Completion Guide release. We'll also be joined by Todd Gamble, who is on his way back from a meeting. He is the partner heading up our risk advisory and restructuring team. Now I'll hand over to Peter. Thanks, Pete.
Yeah, thanks, Tony. Thanks to all of you for joining us. It's good to see some familiar faces or names there. So I know there's a few of you who have been to quite a few of our events in the past. So again, as Tony says, appreciate you taking the time. It is a tricky time. If you're anything like us, there's a lot of work still to do, and before year end, and then obviously you'll be doing year end planning for clients as well. So, but look, this is obviously a fairly controversial topic. We thought it would be worth just having a session to go through this with the group, and it's pleasing that quite a few have shown interest in the topic. So we're happy. So I'm going to spend the time here just going through some of the overview of these rules, which I'm sure you've read a bit about, and as Tony says, what's changed, and importantly, because it's not like, this isn't like we've got rules that this is the rules, this is how it's going to apply. We're hoping there's going to be changes, because certainly I'm not happy with the way it looks. I know the professional bodies are not happy, and this is one of those drafts where you'd like to think that the final will look a bit different to what we're dealing with, but we've got to at least have some awareness as to what this is, what's in here, and how it's going to could potentially impact your clients or even perhaps your own practices. So the specifics, as we indicated on the invitation, we'll firstly touch on briefly what the rules were, which you would recall was suspended back in 2017. So we have been in a bit of limbo, waiting for the ATO's next move in this area, in terms of how professional partner profits are allocated. Then you've got this quite complex mechanism that's been outlined in PCG 2021 D2, which, so I'm just going to sort of unpack each of these elements and then talk about how some of this might apply in practice. You've got these gateways that have been put forward to even get into these rules in the first place. The idea being, if you don't pass the gateways, then there's potentially higher risk, and the ATO might want to have a closer look at arrangements anyway. And once you get through the gateways, there's this idea of traffic light zones. We're looking at low, moderate, or high risk. And then a risk scoring table that gives you a scoring sort of matrix to sort of get into those zones. So as I said, you can already see it's a pretty complex approach to this, which perhaps overly complex. I think most people a lot of people are suggesting. So we will discuss, I'll discuss some of the scenarios where we see most likely risk in the risk level under this approach will increase from what would have been from the old rules, and so a lot of people were generally not too unhappy with the old rules, but the new rules are going to be a lot more problematic. And then I'll go through in a couple of slides some of the recommendations for improvements that professional bodies, in particular the two that I'm a member of, the Tax Institute and CAANZ. I'm sure CPAs have got their own. There was a joint submission overarching, which you probably saw, from a number of the professional accounting bodies, and they each also made their individual more detailed submissions. So no doubt CPAs have got their own, but I haven't looked at that one. But there's definitely some common themes coming in the two that I have looked at, and we're going to send that. We'll send those, the actual PCG and those two submissions out with the materials, so you can have a closer look at that. So just starting a polling question. So just interested as a sort of starting point, are you advising professionals who you believe may be disadvantaged by these guidelines, and noting that perhaps you yourself might have concerns about them for your own practice, but I'm sure you've got other professional clients who are also impacted. So if you could just indicate yes, no, or unsure, just to get an idea what people's thoughts are before we get into the detail. Okay, there we got Todd, and Todd will throw his 2 cents in as we go along. So do you want to jump anything in now?
Yeah, the overarching thing I see here is from me not being a non-tax person, is also the unintended consequences that flow out of this, because this will impact how everybody manages their wealth management, their debt, and their future structures. Like it's not just one issue; it will impact the whole structure.
Absolutely. Yeah, look, it's a much broader, and there's so many considerations here. And I think, yeah, it does feel, as I'll discuss, that there's a feeling that the ATO perhaps hasn't quite, there's obviously a group in the ATO who have been looking at this, and I'm not sure that they've really understood a lot of the real world implications of this. There's views in the ATO that are leading towards this, but so much of this is not really as practical. And that's what the Tax Institute and CAs have tried to point out, some of these issues. Clearly, 2/3 of you see issues with this. I know I do. Interestingly, no one's saying this is all fine, so that doesn't surprise me either. There's no doubt a bit of uncertainty, and that partly reflects the complexity of this. So that's good that there's a few things to talk. There'll be a few things to talk about here then. So we might keep. Okay, so we'll keep moving through then, and then so just to start this off, you would be aware, hopefully, of the rules that the ATO had in place previously. I thought they were reasonable. You know, you could manage them. They had these three factors which are similar, maybe not completely identical, but there's a fair bit of similarity between these old rules, which were suspended in 2017, and at that time the ATO said, well, we think we need to go further with this, so we're going to go and have a look at it. It's taken them 4 years to come back with something, and so you know, those benchmarks, as you may recall, were you could look at appropriate remuneration, essentially look at the high-paid professional staff in your practice, and if you can benchmark. A lot of this is based on an IPP, so a individual practice, you know, so a professional, basically a participant. So if you're a partner in the firm, that all of you guys who are owners and partners in your firms, in whatever the actual legal structure is, and if you've got clients who are lawyers, architects, actuaries, whatever the professional thing is, you'll likewise, it's those owners of the business is the IPP. So all of these things are based on that, and what is the IPP actually showing as income compared to what might go to their family members or other related entities. So I'm sure you realise, but just to be clear, that's what this is all about. So if you can show that the IPP themselves are benchmarking their remuneration, then you could really probably justify it on that basis. Alternatively, if they were getting at least 50% of the total profit share, then again the ATO could be satisfied that was okay. Or a 30% effective tax rate so across the group. So you're not, and that probably wasn't too difficult to satisfy depending on the situation. So any one of those three would get you there. Needed a bit of careful planning, but it could be done. But now we've got something which is way stricter than that, and that's obviously very deliberate from the ATO's perspective. They thought this was too generous, so they've gone in and come up with something much more difficult. So, but not only is it stricter and going to catch more people, but it's way more complex to apply, which is, and that will go into Todd's point about the unintended consequences and the practicalities. Call it practical, commercial, whatever you want to term you want to use. It's all those considerations which go beyond just the tax situation. And it's going to make life a bit difficult. So the question is, how do we deal with that? What do you advise your clients? So So I'll just then start getting into some of the detail, and as Tony said, throw in some questions. I'll try and move through this detail, but then we can perhaps go. It's probably better that we do address the questions as once we've got through some of this explanation. And so the two gateways, what the ATO set out. Firstly, they talk about, and it's very hard to understand the logic, as you always say, Todd. Don't apply logic to these things, and but it is sort of a bit hard to understand the logic of why we have to go through this. We've got a very detailed set of rules before we even get to that point. We've got to go through these gateways. And these two gateways, certainly gateway 1 is a very vague, subjective one that they want you to show actual commercial benefits, appropriate documentation, and not an overly complex structure, and sort of the actual reality of it reflecting the economic substance so it's not exactly Part 4A. They're not saying that it's mirroring Part 4A, or that they could simply, you could not have this gateway, and this is part of the feedback that has come. You could not have this gateway, and they've always got Part 4A to apply if they think something is just not commercial, not appropriate, non-commercial, but without even relying just on Part 4A or on the or the PSI rules, for example. Remembering that you could simply invoke the PSI rules if they believe that income is that should really be going to a partner, an individual, because it's their individual efforts, personal. You could go through those PSI rules and have Part 4A without necessarily having some of this, but we've got all this being overlaid over the top of those rules.
And Peter, that is really what the ATO doesn't like. That's the partnership of trust sort of model that they really don't like. So that sort of appropriate documentation is obviously there, but it's a complex structure then in a lot of those circumstances. And you've got layering of rights and all of those things as well. So it is, I think that's probably the one they're trying to narrow down. But yeah, maybe, and they have obviously pushed the boat out a long way, and I think they expect to come back a little bit and refine it. I hope they do. Otherwise,
well, I'm certainly hoping that too.
Otherwise, the other unintended consequences is a lot more tax advisors are going to earn a lot more money, because this is going to take a lot of work to get through.
Oh yeah, but it's not particularly value add though. It's certainly not helping people with their businesses, and it's dealing with bureaucratic sort of issues that just are not. You'd rather be advising on something much more useful for the business and the practices. So it's the thing, and certainly the consultation. I know I sat in on a call with a CAANZ with representatives from a number of other mid-tier firms, and certainly one of the things I learned in that call was that there'd been a lot of consultation prior to this. Confidential consultation. So the ATO has been engaging with the professional firm bodies, but what they didn't do is then come back and say, okay, right, well, here's our draft. What do you got? What do you think? And then get a sort of a bit of a sign off on it. But they seem to basically just had all that consultation and then just gone away, come up with something and lobbed it out in the public domain. And there is, I think CA's actually had a specific comment in their submission that there's one of the paragraphs in the PCG talks about this has been developed in consultation with professional bodies. Well, they're saying, well, can you please take that sentence out, because we don't want to be seen to be endorsing this, because we actually didn't, yes, you talked to us about it, but we didn't actually endorse the final product. And they've certainly again put forward a number of arguments as to why some of this should be changed. So because then you move on to this gateway 2 again. It's a lot of what they see to be high risk features, which will take you out of this completely and say, well, if you've got any of these features, then you don't even get to apply some of these other rules. We're going to consider you relatively high risk and possibly have a closer look at your arrangements anyway. And that's something that's subject to a taxpayer alert. That could be any taxpayer alert. And one of the concerns is, are they going to then, in the wake of this, are they going to issue more taxpayer alerts? So is this going to expand it would be very easy for the ATO to come out with, look, see something they don't like, issue a taxpayer alert, Oh no, and then that pulls those arrangements out of these rules, and then lets them target them specifically. But which I mean they could always do anyway. But that's the financing that probably goes to your point, Todd, about there's examples about where about transfers of certainly in an equity in a sort of a goodwill partnership model or goodwill firm where people actually they do buy into the practice, or they do acquire an interest in a practice that there's a transfer from an individual perhaps to their family trust, or their family trust buys an interest, and that is in itself, even I think the HO seems to acknowledge that in itself is not necessarily a problem as long as there's enough income flowing to the IPP themselves. But they say once you throw financing into that, and there's finance, then that's if it's a non-arm's length transaction, it may be for market value, but because it's between the two related parties, and you finance that, they say that automatically makes it high risk. And the question is, well, why? Why is it not appropriate to finance that transaction? So that's an interesting comment, an interesting one.
Yeah, I would have thought that'd be a question for the financier rather than for the ATO about whether it's high risk. If you can get finance, you can get finance.
Yeah, well, that's right, exactly. So
is that right from Tony, the ex-banker?
Agreed.
Yeah. Okay. Good. Anyway, I won't get bogged down too much on this one, but just I think it's sort of people could probably hopefully get the idea that they're throwing out some things that are supposedly high risk that you would argue have commercial rationale. Some accounting and tax differences. Now, I mean, there's a bit of discussion around that, but it's looking at things that appear to be a bit artificial and perhaps goes a bit far. That one. Assignments of partnership interest. Now, it's well known. I mean, you've got your Everett assignments, that the Everett's case is a long-standing law, and that's perfectly acceptable. They talk about assignments of partnership interests that don't sort of fit with the requirements of Everett's case, and I think that I know there has been a bit of activity around Everett assignments. It's been perhaps a bit of a resurgence of those sorts of transactions in partnership interests, and perhaps some people were pushing the envelope, and that's why the ATO has reacted to it. And but not really. It's not really spelt out what those things are that they don't like. But there's obviously things that they're happening they don't like. So, but again, the point's been made. If there's something you really don't like, just target them. Don't target everybody, because there's some people are doing things that you think are pushing the envelope.
Yeah, I mean that could inhibit all of all the transfers of firms that need to happen over the next few years. I mean, we've been told how many times that accountants are getting older and all that sort of stuff, and there's a lot of principals who need to exit and transition, and that's a servicing issue for the industry. So you'd start taking some of these things away or make it more difficult, and people get less interested.
So anyway, so it's going to be some interesting, and just the final point on that one, which I think is the big one, that having multiple, it's not uncommon to have multiple classes of shares or units, and in fact there's a general point there that there's not a lot of examples in this, and the Tax Institute in particular in their submission have put forward some examples to sort of try and counter, I suppose, add to what the ATO has essentially put forward examples of. A very limited range of examples of where they see if you do these things, you'll be low risk. What they haven't really spelt out is, okay, what's going to be high risk, and they probably haven't got a sufficiently broad range of examples, case studies, and the corporate structures, which are increasingly common, don't really get a good outing there, and it is fairly common to have multiple classes of shares and not equity owners, and we'll get into towards the end some of the issues that are really not fully addressed in this. Again, it doesn't fully reflect what's actually happening out there in the real world. Non-equity owners, you have non-equity partners, you have partial equity and full equity partners, and that whole range of interests in firms is not fully appreciated. And in itself, the question is again, why does having multiple classes of shares in itself make it a high risk? It depends how the income flows out on the tests which we're about to go through. That could cause some issues, but why does simply having those classes of shares automatically make it high risk? So that's something that certainly you'd hope that will be reviewed. But I might just move on to the again, I think that the crux of all this is these two tables, which we'll go through here. So and this is where you start to see the complexity. So again, as we touched on before, we've gone from 3 tests. These are broadly the same sorts of tests that we had under the old rules, where you could satisfy any one of them. Now you've got to get a score. You've got two factors in particular. The percentage of profits that the IPP of profit share that's returned by the IPP themselves. And they said if it's 100%, so if the IPP puts 100% of their profit share in their own name, then that's straight up, that's low risk. They say, well, there's no mischief there. But once it's anything beyond that, or outside of that, then you've got to apply all of this. And so you start looking at this scoring. And so I've highlighted in particular, and you'll see on the next one. This is where I'm going to have to flick down a little bit between these two. Green zone, low risk. You want to be low risk here. You want to be a 7, basically on factors 1 and 2. You can throw in 3 and the third factor and be a 10, and I'll discuss that in a second. But you want to be in this range here. And one of the problems with this is if you flick from 7 to 8, you're automatically at a green, and from green to amber, and that's basically saying green, we're not going to really look at you. Amber will have a bit of a look at you, and we may take things further. Red, we're going to high risk. We pretty much they'll definitely look at the arrangement. They'll prioritise those reviews. They could go straight to audit. They're the sort of things they're saying. So again, without getting into the detail of what the HO will do, it's probably enough to say to start with is that you want to try and be green if you can, and then and be below the not on the HO's radar. So it comes down to how do you get there. And so what I've highlighted here is that I think the most likely, so I'm not going through here sort of detailed case studies of what will work and what will not. I'm trying to keep this discussion fairly broad, but I've touched on a few of the factors that'll get you to this outcome further down in the slides. But it seems to me the most likely way you're going to get to a 7 is to get a 4 on the first one and a 3 on the second one. There'd be other permutations that you could get through, but so if you get
that's most likely while minimising your tax position.
Obviously. Oh yeah. Well, getting the best outcome, and one of these submissions that I forget which one it was. I mean, there's a fair bit of crossover between what the tax insurance CAs were saying, but one of their recommendations was that perhaps that you'll note the greater than on the first greater than 50% to less than or equal to 60%. One of the submissions was, well, why isn't that greater than or equal to 50%? So if you're exactly 50%, then you're actually you're actually a 5, not a 4. So so go from 49, 50, you're in a 5. You're a 5. Then if you get to 51, then you're a 4. And why can't you be a 4 at 50%? So that's a sort of a technical thing, but that could make a difference. So you've basically you've got to get to like 51% of the income going to the IPP, and it could flow through. They're not saying you can't have a family trust. You can flow through a trust or a company, but it's got to end up. And there's a few unanswered questions about, well, exactly how do you work that out?
And I would have thought, I mean, subject to the numbers, the difference between the 50% and 60% is probably the closest sort of position, right? Like there could be, particularly if you're at the top of that band, if you're at like 58 and to go to a 3 to make it even more safer is probably
sure. Yeah. So that's the thing. If it may be, if you're getting up to 58, 59, then maybe you want to get to 60, but again, you've got to get to 61, not 60. So it's just a bit silly, some of this. It's so prescriptive, and so I would think that in a lot of cases you'll aim to get to say 51, and that would at least get you a 4, because that you pair that with the second one, which is the effective tax rate, and it's again, there's a bit of a technical analysis as to formula to how you get there, but it's you, broadly speaking, you're talking about the average tax rate on the firm profit share and how is it taxed. So it's not coming through. If it comes through as a well, certainly if it goes through trusts and ends up in a corporate beneficiary of a trust, then you're probably still going to get to a 30%. If it goes directly to a company, it could be, and you've got a sort of the base rate entity rules applying at the practice level. So you're at, say, a 26% tax rate at the practice level. That income could still potentially be taxed at 26% at the company level. So you've got to think about how it flows through, what your structure is, how it flows through. But if you flow, just broadly speaking, if you flow income through a trust and you end up with that going to a corporate beneficiary, then you could still end up, you could still end up at 30% tax rate. Now you've got to be over 30%, so not 30%, but over 30% to get to a 3. So what you'd be looking at is, say take a particular example, you've got the IPP themselves, their spouse, maybe kids over 18, but this depends, but certainly commonly the IPP and their spouse at least, and maybe then a corporate beneficiary. So you're basically going to look at there, and I'll touch on this in a later slide, but you're going to looking at there the individuals having, getting in above, you've got to get the individuals above a 30% average tax rate so that it all averages out to more than 30%. So that's but that's that, if they're giving you that 30 to 35% leeway, I guess, band to and I've sort of got some numbers on the latest slide about what sort of income levels would get you to that, but you've got to get to that band to be a 3, and to me that's how you get to a 7. Well, that's the most obvious way you get to a 7 is buying a 4 on the first one and 3 on the second, but that does require a bit of planning, and it may not, and it's not going to suit every situation, and so there's a number of issues which again I'll cover further down. Now the third one is optional, so I think that's a good move to make it optional. So but how's that going to work in practice? It's you just get focused on getting the best score you can, get to a 7 on the first 2. If you can get to a 7 on the first 2, you wouldn't even bother with the third factor being the commercial benchmark, and it's.
But to be able to do it, I mean, to be able to do the first 2, you're probably going to knock over the third one anyway. I mean, it's
possibly, yeah, and you could, so you might get to 10. Again, you've got to be, and if you're at 7, again, why bother even looking at this? But if you're at 7, then you'd have to stay at no more than 3 if you apply the third one, and so you've got to be, means the IPP's got to be receiving more than 100%. Of the commercial benchmark, however that would be, and again that's not completely clearly set out how you would determine that. I've heard different views. Some people say, oh, that's hard to define, hard to determine, this, let's not bother with that. Others have said, well, that's actually one thing you can, it isn't that, you can actually benchmark the value of someone's services, and if you can do that, maybe that's helpful. But I guess if you're going to one way I see it is if you're an 8, under the first 2, and you want to get yourself back to a 7, that means you have to get to a 2, which means if they've got to be more than 150% of the benchmark. So and then, as you say, Todd, if you get, I think I'll probably look at it maybe maybe it's the flip side, flip what you said around. Say, look, you're going to get to 150%, depending on what sort of numbers of profit share we're talking about here at the IPP level. What someone's profit share is, if it's quite a large number, then possibly they probably well and truly they may get to the 1 or 2 on the benchmark, because they've got a probably large profit share, and they also pay quite a lot of tax on that. And so then therefore their total tax rate maybe is getting up there.
But if you look at it the reverse way, yeah, if you do that, if you got them to a 2, they're probably going to be a 2 in the effective tax rate anyway.
That's right. So they're probably looking relatively safe, and then what proportion, and then if again it's the proportion really then comes down to what their total profit share is, and then if you've got $1 million profit share and you may actually be below 450%. So it could be or even just at 50% on the first one, but then you might actually satisfy the second and third one because the tax rate being paid is still pretty high and you're over the benchmark.
I mean,
So,
it does feel like the sort of mid-range to larger partnerships would be the ones that are probably going to be most exposed here, where there's a lot of money floating around and there's incentives and all of those things tacked in with it as well, and bonus structures. Whereas
yeah,
I would have thought a partnership of sort of 3 or 4 or 5 or 6 or 7 or 8, it's pretty clear how the distribution happens, and the tax structuring is cleaner as long as there's an understanding of what the individual gets to, and everybody needs to agree that that's how it all works. Because the problem I can see is that one person not adhering with it because they decide not to distribute in their trust properly.
And that's a point that's been made by the sort of, again, the professional bodies is that there's a bit of mixed terminology in this. It supposedly applies to the individual practitioner, but the firm's going to want to make sure they're not exposed and that everyone in the firm's complying. So is it on either, and it's somebody has said that it's either it could go one of two ways. It could either mean that the firm's going to, again, especially larger firms, are going to either have to pay much closer attention to what every practitioner, every partner's doing, and they're going to want to have to. There's going to create more bureaucracy in that to make sure they're all complying, or they might just take a hands-off approach and say, well, this is all too hard. Everyone sort themselves out. So it could actually really lead to less compliance because the firms aren't keeping as close an eye on it. But as you say, you've got to think it's a risk for the firm's or reputation or the firm just generally. And so they'd want to be, as a firm, you'd want to be across this. And so it creates a bit of a mess in terms of trying to juggle between the firm's situation and each individual partner.
We all love tax audits, mate.
Yeah. That's right.
One of the most painful things in the world. So if anybody, all the firms will be trying to avoid that, I'm sure.
Yeah, absolutely. So it's messy, and so I think, as you say, if you're at the smaller end and the numbers are a bit smaller, I mean, you could have a very profitable small firm too, of course. But if your numbers are a bit smaller, query whether the benchmarking really you could come how that's going to really help.
But I think in those smaller things, it's a distribution of profits, right? There's less major movements on bonus structures. Like some of those like mid-tier law firms and larger law firms have significant bonus structures and incentives where you're getting hundreds of thousands of unique distributions because they're bonuses, and they can throw this out. That's what I can see.
Yeah, look, it could get very complicated, very messy. So ultimately, I still have a question mark over the viability of the third factor, and I think in most cases you're going to be focusing on the first two, and then, so as we said, that's again becomes sort of problematic how you get to a 7, and that you come back to the key point as to it's so easy to flip from a 7 to an 8, and so that's where this issue of something that used to qualify because we could meet one of these 3 factors, and we'd be like, okay, good, tick that, we're good. Pick which one is easiest to apply, and you're good to go. But now it's a very you've got to go through this complex methodology, and it's not just won't be the same every year. Like you say, Todd, if you have these bonuses and everything changes, and it's something you've got to look at every year and apply every year, which I mean you'd have to do anyway, but it's so easy to flip from 7 to 8 or even a 9, and then if you're in that higher range, how does that benchmarking factor then get you back below that? I think it might not be, you've got to then be getting a pretty high percentage of the benchmark to come back under the in that third column, so that last column. So I'm questioning how often that would actually be able to help you. So so this is the bit in the middle column there, which is you're really going to be looking at. So probably take that and say, well, how do we then, what does that mean for us? In reality, this is some of the things we've just been discussing. So what I'm saying there, I think maybe 1 or 2 others. So yeah, firstly, the IPP is taxed on more than 50, as I said, more than 50% of the profit share. Can flow through a trust or a company, corporate benefit. But I mean, there's a question mark over the timing too. That it's not clearly spelt out. If you got corporate structures, and there's, again, the comment's been made that these don't really explain exactly how corporate structures are dealt with. You have a delay on paying out profits, say until the following year as dividends. So how do you really measure that? It's the previous year's profits, but then being the dividends flow out in the following year. So, you know, and I take it at face value that it's what comes out in that year that you're dealing with, as opposed to the previous, because it seems pretty hard to do it otherwise, but it's not really spelt out. But certainly when it's obviously it's easy to understand when it's flowing through a trust, because it has to come out in that year. So and the way I take it is, if you take it to a corporate beneficiary, then if you're looking at what the IPP gets, the fact that the IPP might ultimately get a dividend from that corporate beneficiary in a subsequent year, I'm not sure that helps you. In the first instance, you're sending a certain portion to the corporate beneficiary. So you've got to look at ultimately what does that person get, what is that individual getting, either directly and cost practices, especially the larger, like those larger law firms you mentioned, or larger practices will have multiple entities. So there'll be a partnership, perhaps a company, a service trust or something. So you use all of those different vehicles, and the IPP will receive different elements of their profit share from different places. So you've got to accumulate all of that, see what ends up into their return, and do they get more than 50%? And that'll be the key to getting a low risk structure. And also, as we said, that having an effective tax rate of overall of more than 50%. So those first two dot points really encapsulate what we've just been discussing. And then if you're going to use the IPP remuneration on a benchmarking, you would have to be as a minimum, you'd have to get more than 100%, and perhaps the 100, as a touched on, 150% would bring you to a lower ranking. That's sorry, go for too far there. 150 over 150% gets you to a 2. So it's whether by getting to a 2 that helps you get to a lower ranking. That's the only thing there. So putting some more specifics to it in that last dot point there on this slide. So if the individual, so we've got a question there. I'll come back to the questions when I'm finished. I haven't got too much more material to go through. So Brad, I'll get to your question in a second. So say all individuals in the group, and that might be just the IPP and their spouse, perhaps. If they get firm income of at least 195, then that will, at the current tax rates, and I'm working on the basis that doesn't include Medicare levy. There's no, that's not spelt out either. So as to, unless I'm missing something, I haven't seen anything that says that it includes Medicare levy. So if you work on the basis that I'm happy for anyone can point me in to say anywhere that says it does, but if you work on the basis that it does include Medicare levy, then you've got to get to about 195K of firm income. And if it's a dividend, that would be the grossed up amount. But to get to an effective tax rate of more than 30%. So that's again, that's where you would, anything less than that, you'd have some individuals at more than 30, some below 30, and then if you've got a company paying 30%, so as a corporate beneficiary, it's got to all average out to more than 30%. So ideally, the individuals plus the corporate beneficiary should each be paying the company pays the 30%, the individuals pay more, so that the overall tax is at least a bit over 30%. That's what you're looking for. Alternatively, the other way to look at that, and that's getting to your 4 and 3 sort of score that I was talking about earlier. Alternatively, the other way you might get there is the individuals receive at least 90%, 90K. It gets you to an effective tax rate of more than 25%. So that would be basically and then the IPP receives more than 60. So like you were saying, Todd, before, if you're at 58%, you might try and make it so you get over 60. And so that means that they'd be a 3 on the first factor, and a 4 on the second. So but you can't be, you don't want to be 4 on both. So if you're 4 on one, you've got to be 3 on the other. So that's what makes the planning a bit difficult. And it's going to be very easy to get to it. It's going to be very easy to get to an 8. So that's where or possibly more, but I think there'll be a lot of 8s coming out of this analysis. So, and that's not moderate risk, which again, it's not like we're going to come straight out at you and go straight to audit, but it's serious enough that then they're going to want to have a look at that arrangement, and that you don't really want to be an 8. And that's what I take out of all this. So, and so this is really that's really the point, that the a lot of the IPPs will pass one test, but other factors will push them out of the green zone, and that's the problem with all this. Is it just doesn't quite. It doesn't. It's just. It's too harsh. You know, it's too prescriptive, and that's so we're down to then. So I come down to the probably, you know, I'll probably just rip through this so we can address any questions or further comments, thoughts that Todd might have. So that brings us to the final question. Well, you know, what were the final point, which was how do the what are some of the queries or recommendations that have been put through to the ATO, which will hopefully change some of the final outcomes in terms of when it's released as a final document. So the first obvious point was, what is a professional? It's not really clearly defined. It's a very loose question. You know, when you got things like the PSI rules, you know, why is a professional accountant, lawyer, architect, actuary, why are they different to a tradie or a management consultant? Remembering that a lot of large professional firms have management consultants and other types of consultants in there already, so they're providing more than just traditional accounting services. But if you're a standalone management consulting firm, presumably you don't fall within the ambit of this. And definitely, if you're a tradie, you can do your husband and wife partnership without any problem at all. And that's that traditional model of how a lot of those tradies operate is no problem at all. So it's you know, why are they actually singling out professionals in this way? There's obviously a deep held view in some areas of the ATO that you know, professionals are not paying enough tax and should be brought to account, and it partly comes from maybe overly complex structures that have been there. But again, if there are overly complex structures, so that's the second point. You know, the PSI rules are there. So if you
is that because all the tax advisors have come up with these overly complex structures, Peter? Have you brought this on yourselves, the tax partners around the world?
Some might have. I wouldn't claim to be or contributed to that. I like to keep things simple, but there's no doubt that there probably are things, and it's like the Everett assignment, things like Everett assignments, that we know that can be done, but if people have pushed the envelope and put in something that is too complex, then yes, it's caused a reaction. It plays into the hands of the ATO's views that they should be cracking down harder, but it's probably, I don't believe it's warranted really, and it doesn't, not to this extent certainly. And you've got Part 4, you've got PSA, you've got Part 4A, so it'd be more targeted. So other queries that have been raised, impacts of fringe benefits and packaged super contributions. Now, you know, if they're simply making your own personal contributions, which is easy enough to do, then that super doesn't really impact this, but too much. But if you've got packaged contributions and or fringe benefits, then that's not properly addressed as to how that impacts these tests. So, you know, again, that's the point, is perhaps that needs to be considered.
If the overriding government position, which is that superannuation for business owners, like who would probably qualify under the professionals thing, needs to be made so that they have superannuation at the end of their careers, well, I would have thought that would be excluded on a public practice sort of basis.
Correct.
Because,
yeah. It should be encouraged. It should be encouraged. And
so the deduction for that is not part of the calculation then.
Yeah, so it's just not. Yeah, so it's just not fully. That's just not it's just not addressed, and it should be. And which it highlights the point that this really, why are public practitioners not looked at in the same way as other business owners, which is basically what they are. And so safe harbors, again, a call for some safe harbors. Like if you've got a very simple partnership structure, service trust. I think actually I mentioned that separately, but you've got Philip's case, you've got the service trust arrangements, which have been in place for like decades. If you've got case law that supports the use of a service trust with reasonable benchmarks, why, you know, that hasn't been addressed either. So they're basically saying, well, ignore the previous guidance on service trusts, and they you could carve that out and say, we'll accept that. We won't make that part of the calculation, but they've the service trust income that's being diverted through a service trust to other family members or entities will contribute towards people failing these tests. So, and yet the rules are there that allow that. So it just doesn't fit either. But having a very simple structure with a profit share less than 180k, because when you apply these tests, you can see that actually having a profit share of less than 180k, you're not paying the levels of, you could end up having, it doesn't make sense, because you're going to end up having a high rating because you're not paying enough tax, but actually that's because you're actually not making that much money.
Yeah, if you do the comparison with the individuals, like if you do the 80 grand or the 90,000 in the individual's hands, you're actually being penalised under this structure.
Yeah. It's not, and not even, and again, that doesn't necessarily have to be the case every year. Someone can have an unprofitable year, or they have situations that cause the profit share to be lower for that year. And another suggestion is that if you've got non-IPP entitlement of less than 35%, so the IPP share is, and again on the simplistic, and they're simplistic examples, they say, well, they're just looking at the simplistic examples in the PCG around partnerships. So it's not looking at corporate structures and other things. So that if the IPP themselves gets a 65% share of the partnership income, of their profit share in the partnership, surely that's enough. So without going through all those other complicated factors, so the calls for a safe harbour on that basis.
Yeah, and if they're getting a wage paid, like if whatever their wage is being paid in the business, that should be separated out. Yeah.
Just whatever they get, however they get it, as long as they're getting that 65%, that's maybe an arbitrary figure, but it seems like a relatively reasonable number. It would show that, so they're the sort of things. There aren't those sort of safe harbours, which would just mean you'd have to go through this whole process. As we highlighted, the risk factor scoring means that a very small change, you flick from 49% to 50, or 50, you go from 51% down to 49%, and or an income level, you just go below a certain income level. Then you suddenly go from a 7 to an 8 or something, and then that's just the consequences of a very small change are quite significant, and there's got to be a better way to do that. You've got to have thresholds, but it just doesn't. That's a concern.
Well, your tax payable percentage, right? If you take super out and you're paying your maximum contribution, well, that could be the difference, right?
And even the query about Medicare, is so Medicare, the whole thing about Medicare, the whole stupid thing about Medicare, it's not Medicare levy is not a tax, so therefore it doesn't count, but should it count? And the point we've already discussed, obviously we've already covered a lot of this stuff in the discussion. So the obligations that it places on both the firm and the IPP, it's definitely an additional compliance burden and risk for both the firm and the partner. And then again, probably I didn't mention similar to so you've got tax rate changes, you've got base rate entity rates. If dividends are coming directly from a company that is paying the 26, and then it'll soon to be 25%, that makes it hard. That's going to be harder. 30% is a fairly arbitrary threshold that's been set, and it might make more sense if every company was paying 30% tax, but some companies are going to be paying less than 30% tax. So that's going to make it harder means the individuals have to pay that much more tax to average it out. So, and then once the if the stage 3 tax cuts come in, which probably is if the Libs win the next election, then that will again have another impact on the actual average tax rates potentially. So, and that may be deliberate. They might have factored these outcomes into the calculations or into their thresholds, but it's all going to have an impact. So just got to be mindful of that. So just going through the nearly at the end here, just to go through a few points there. So corporate structures, as I said earlier, why why discretionary dividend shares or different classes of dividend shares listed in Gateway 2? Why is that such a prominent point? It's not completely clear of the franking credit, how the franking credits come into the effective tax rate, and it's just there's a bit more clarity to be done. And as I said, the timing of it's pretty common that dividends are paid out subsequent to the year, so there's a lag in paying out dividends. So again, that's not really addressed. So that there's a lot of corporate type issues that are just not fully addressed, and yet corporate structures are very common out there in the real world. So there needs to be some more thought around that. A big one that's been raised is equity partners or non-equity partners, or different levels of equity. You know, if you've got 3 people in partnership and they're all equal, then okay, this works. But a lot of professional firms, it's not as simple as that. So there needs to be a bit more analysis around that, and you don't want to necessarily make it more complex, but if it's a reality that should be recognised. And even this, the point with dividends, there seem to be the discretionary dividend. I guess the concern is more around having those dividends going to perhaps family trusts or certainly to spouses, but they're also used to make distributions to a non-equity partner. So they are a partner working in the practice, but just they get their profit share through that sort of way. And, you know, again, why should that not be allowed to a certain extent? Now, if that gives them a bit of income, I mean, it gives them a bit of income splitting, and perhaps at the end of the day, the ATO doesn't want doesn't want to give that income splitting opportunity. I mean, that's what's behind a lot of this. I think the income splitting opportunities go too far. But again, they're available to most business owners. So why should these practitioners not have the same opportunities? So again, a lot of issues there that just are not completely fully addressed. We touched on the borrowing. Again, borrowing by discretionary. They seem to have a real issue with borrowing by discretionary trust to acquire an interest in the firm from the IPP. So it's the related party. I mean, you were talking about practices and having to do things. I mean, I think it's not so much of an issue with related party sales or transactions, but certainly anything that's unrelated party, but anything that's a related party transaction, they immediately have a concern on borrowing.
Yeah, there needs to be like a valuation structure put in place and all that sort of stuff. So there is some sort of assessment, because
I mean, you can do it. Yeah, I mean, you can do
a
it.
Mandatory structure in a lot of partnership agreements, but
yeah,
whether
and you
that's
could do
relevant.
it. Yeah, you can do an arm's length transaction between related parties, and I don't think there's a recognition of that. Now, I already mentioned that the Phillips case and the service entity guidelines are just not factored in here. They're not accepted, even though that's long-standing case law, and the ATO has acknowledged that for years, and suddenly they're sort of ignoring that. So that doesn't seem equitable. And then just at the very bottom, it's not quite cut off there, that last dot point. All these factors are very prescriptive. That's the final point we wanted to make, and that has been made by others, that it doesn't allow for things like fluctuation in profitability, the personal situation of people, periods of illness, extended sabbatical leave, you know, that so year on year.
So some of the benefits of being in a partnership, of actually having partners who can take up that sort of slack, and
yeah, well, that's right.
Supportive, right? Yeah,
that's right. I mean, there's an assumption again. There's just and so it'll lead to, some of these factors will lead to situations where you'll breach the tests, but there's good logical reasons for breaching the tests. It's not because you manipulated your tax outcomes. But again, that's not recognised.
You'd never manipulate tax outcomes, Peter. I don't know what you're talking about.
You do planning. It's called tax planning. So, but you know, legitimate tax planning. So questions. So questions. Now I call of this. Now, Brad, I'll just look at Brad's question now. My old friend Paul Bailey, of course, raised a question.
I'll read that Paul Bailey one out for you.
You can always count on Paul for something. So if you want to that,
you do Brad's, and I'll get Paul's ready.
All right. So, well, I'll just comment on Paul's, because it was Paul. Your comment, as I recall, was very much.
Well, I'll read it, Pete.
You read it out. Read it out for everybody. Yeah. Okay.
What is the most favourable business structure for these types of entities in 2021? And can you provide a scenario for a small firm and a larger firm from 1 million turnover to 10 million turnover? And I understand that's part of what you will go out in your email out to.
Well, so what I've done, how I'd address that, and I looked at your question last night, Paul, and my feeling on that was I didn't feel that this was the forum to go into detailed case studies. It was more of a general comment that it's not. I don't think this is the sort of thing you can say this is the best structure. This is, in fact, I mean, the easiest structure, the safest structure is like a partnership, just receiving income directly, and then the HO will leave you alone. But you can sort of obviously have. You can have corporate structures. You can have, as Todd said, there's partnerships or discretionary trusts that are quite common that maybe get a bit complex, and the ATO has a bit of an issue with that. But again, if the income's flowed out to the IPPs to a certain level, then you could still probably manage those sort of structures. But it's not so much saying, well, this is the structure you should use or not. It's what outcomes does that, what ends up in the, how do these factors apply to you? What ends up in the IPP's tax return in the end? How do these different factors, what score do you get? How do you get yourself to a 7, as we've been discussing? So that's what I've focused on in trying to address your question, Paul.
It's not about, it's about not taking the piss too much, right?
Yeah, well, understanding what the
30 to
HO's
40% tax rate across all of the income that comes through or you are received, and you're sort of getting pretty close to being okay.
Yeah, yeah, that's right, and that was in fact that was the slide where I went through. Okay, what would get you to a low risk is partly aimed at addressing your question, Paul. It's saying, well, what are the things you should do? And your structure might vary, but if you can show there's some of these factors, then you'll be more likely to get to a 7, which is what you want to aim for. And that will apply to some extent. It'll apply regardless of whether you're a $1 million practice or a $10 million practice. Some issues will apply differently depending on the size of the practice and the level of profitability and how many partners and all that sort of thing. But and I would probably, and the reason we want to send out, one of the reasons we want to send out those documents in the pack is look at the ATO. I'd say to you, if you haven't already, anybody, look at the ATO's case studies, which are pretty limited, and every single one of them is basically saying this is, if you do this, you'll be safe. And they're not necessarily things you want to do. So that's the conservative approach. And then the Tax Institute has taken that and said, well, actually, what we're going to do is look at some case studies of things where you'll fail. And so they've pointed out situations where you would fail, and in trying to illustrate what they see as being some of the issues with these rules. So read them as well. And it's not going to cover all the scenarios that you're going to see in your clients or with yourselves, perhaps. But that's a bit of a pointer to some of how this is going to apply to in practice. And then if you've got other examples, like corporate structures, as we mentioned a couple of times, you've got to really then just apply those factors to those situations, recognizing that the overriding message here is that these rules are not very favorable. Don't think that they're adequate, and so we would be hoping to see some changes. And some, but I guess you've got to be realistic about what how much the ATO is going to bend. But I think the professional bodies are all made their point clear. They're all doing what they can, and it's a matter of seeing where we end up with this.
And I'll just read Brad ones out, Pete, so we can
go ahead.
let everybody know.
Yep.
How would you apply this to non-profitable business? For example, a professional practice that does not make a profit or is break even, and wages are paid to the husband and wife, one of whom is the IPP, who take the taxable incomes to 37K each way, or 37K each year, or up to 45 once that comes through. Hence, the average rate of tax is low. Is this low risk and hence not something the ATO would spend resources on?
That's a good point. No, you haven't missed anything, Brad. That's one of the recommendations was that there should be a safe harbour of less than 180K, and that would completely address this question. And that's the reason why that's been recommended, because it doesn't make sense to target. I mean, this is all about where the ATO would target their compliance resources. So you would like to think, if logic applies, that you would like to think that the ATO will look at this and go, well, this is not worth our time, but they haven't. That hasn't actually, that outcome's not guaranteed
at that level. There's minimal
there
tax
really
risk,
is.
it's transparent, right?
Yeah, that's right. So you'd like to think that even if they start looking at it, they won't go too far. But this PCG doesn't really spell that out, and that's what it should.
Because I know of some law firms, like with material turnovers in the $30 to $40 million, where there are a couple of holders of equity who take distributions from that, and may not even actually work in the actual practice, or are not actual operators or lawyers and whatever else. And they're the type of things, I think, which are of deep concern, because it is things that the ATO are trying to get around.
And there's always, you talk about the husband and wife working, they both work.
Yeah.
The next thing is, I mean, if the wife, like say if a wife, well, okay, let's be say it's the wife who's the part to be, let's be modern about this. Say the wife's the partner, and then the husband works in the practice. And if to start with, you'd want to justify what he's doing to, if he's being paid a salary or something, then justify what he's actually doing for that salary. I mean, that's always, and that would apply to any business technically, that you've got the risk. I mean, it happens all the time, I'm sure, but you got someone on the payroll, their spouse on the payroll who doesn't really do anything. There's always a risk that the ATO, how often it happens in reality, who knows? But if they see someone who's not really contributing and they're getting paid a wage as part of the tax planning, then they could always attack that. So you'd have to be able to justify that as in any business. Yes, it could fall foul of these rules potentially, especially if there are multiple partners, and this is sort of essentially, she's one of a number of partners, and she's diverting her profit share to her husband. But if it's just essentially a sole practitioner and the husband's being paid to work in the practice, well, maybe that can be justified.
But a sensible approach would sort of suggest that at that level, it's not material to change it, and it's a more than reasonable sort of structure.
I wouldn't be stressing.
That goes back to what you talk about.
I wouldn't be stressing about this example, but so I think just maybe it's a couple of closing points on this, and see if but there's a general point here that when we're talking about the practicalities and different firms, I mean, the reality is, if you're someone coming into an existing practice, you don't necessarily get to choose your structure. I think you alluded to that, Todd, too. That the structure is set up a certain way, and you just basically have to sign up to that. And you might have a choice as to how to set up your own discretionary trust or company or something. To
generally, the tax guys set up the structure for a reason.
Well, that's right, and but it's done in a certain way, and generally you follow what everybody else is already doing, and there may be certain commercial reasons why you're sort of required to do it a certain way too, and so you don't necessarily have a choice. So that point's been made as to is that individual partner actually engaging in sort of a tax avoidance sort of structuring, when in fact they're not really being given a choice, especially in a really large firm. That's one point, and just the other point is about restructuring. If you start restructuring to try and, I mean, well, I've said, I suppose, in terms of, I guess probably we haven't touched on
that's the unintended consequence here. Potentially, is it could drive people to restructure to try and adhere with the rules better.
And we've touched. We haven't actually touched on the timing. So supposedly these rules kick off on July 21, but they've said if people, and it's a bit problematic, but if people had structures in place from before 2017, when the old rules were withdrawn, they're saying we'll give you and then they take steps to restructure. So I think it's up to like 1 July 2023, basically. So there's a couple of years potentially to implement this if people have existing arrangements in place. Query if somebody's set up something more recently, or if you've even joined a partnership more recently, do you get that same benefit? It hasn't been made clear, but yeah, if you go and restructure, it may not be the best thing to do, and it could actually, any restructures always the potential to create more tax issues or more tax risk. So you could even get yourself in a worse situation by restructuring. So it's not something you would do lightly. But you can always use I mean, you don't necessarily need to restructure too, because you can use the existing structure, and a lot of it comes down to, and this partly goes back to Paul's question too, not even a matter of changing the structure. It's a matter of saying, well, if you've got the way to distribute profits if you've got flexibility on distributing profits, which often you do, then you might decide to take a more conservative approach with how on a year-by-year basis, if the rules have become stricter, which isn't necessarily it's not initially fair maybe but if you're going to try and comply, one way is simply to change the pattern of distributions. You may not need to change the structure to do that. So that's
we
pretty
need
much,
to sign off, Pete.
yeah. So that's pretty much all I had. Was anybody else? Look, I think we've probably dropped a few people as we've gone over time here. So I appreciate everybody's patience, and thanks for. Feel free to reach out. So we're going to, yes, we've got the poll question here. Like, let us know if you'd like us, anybody to reach out on this or anything else.
And Tony will be sending out the documents that you've sort of collated and put together.
Yep.
So that they can have a look at those things and that might ask some more questions, whatever else. But it is a bit of a moving feast right now. Absolutely. Until we get some clarity from the industry body.
I don't think there's any indication really how soon we're going to get that feedback from the ATO. So this could take a little while, and but just we'll keep an eye on it. But look, yeah, if there's anything, feel free to, happy to talk afterwards. So yeah, let us know if you want to reach out. But again, thanks again for all your interest, and hope everybody's picked up something from that.
Thanks, everybody. You'll see a couple of things go out on LinkedIn. We're also offering anybody who would like to have us a comment on some audit sort of work at the moment. That's an unusual market at the moment where there's a lack of secondees coming in. So there's some opportunities for people who want to get more experience in our audit team. You'll see that come through on LinkedIn. And we're also working on another presentation around wealth management. And our wealth management business has been through a significant change over the last 18 months to sort of take control of their structure themselves. And I'm going to interview two of the partners to talk through what's happened with all of that and what issues they see emerging in the industry, which I'm sure everybody is dealing with at the moment, particularly with the financial planning changes coming through in the next 2 months. It seems to be a consistently challenging area, albeit it is one of those things that needs to be done or is a key part of a lot of firms. So you see those things coming through in the next few weeks. And obviously, Tony will also be in touch asking if there's anything else everybody would like to understand or is relevant. And we'll try and put some things together. So really appreciate you coming along and making the time this morning and listening to Peter and trying to digest this very complex and sort of concerning issue for a number of partners, particularly the younger partners who we haven't had to deal with this sort of structure change before, but really appreciate it coming along. Pete, I'll leave it to you to sign off.
No worries. All right. No, yeah, thanks everyone. Thanks for your input, Todd and Tony, who had to duck off, and Tanya, of course, for helping us with the slides. And look, let everybody go now. I'm sure you got lots to do, and probably be in touch with some of you at various times. But always feel free to reach out.
Best of luck with your end.
Yep. Thanks everybody. So have a good day.